Commercial real estate has been among the slowest to recover from the pandemic. We talked to BXP Chairman and CEO Owen about the path forward for the space.
It has been a rough time. I always say, though, perception is worse than reality. And commercial real estate is bouncing back, defined as office. There are two external drivers that really drive the office business, certainly the business of BXP. One is interest rates, and the other is corporate earnings growth. I think the interest rate story is pretty obvious. Real estate stocks, real estate are primarily a financial asset, and if the cost of capital is lower, those assets are worth more. We had a very favorable inflation report last week, and since that came out, and with the prospect of more rate cuts and the fact that the 10-year now is below 4.2%, it's really escalated our stock price over the last week. The second important driver is corporate earnings growth, because that drives leasing. In 2023, the S&P 500 earnings growth was flat, 0. In 2022, it was very tepid. But here in 2024, in the first quarter, it was up 8%, and this quarter is predicted to be even higher. So when companies are profitable and they're making money and they're growing their earnings, they're more likely to grow, hire people, and take more space. And we're seeing that in our leasing activity. In the first quarter at BXP, the square footage that we leased was up 30% from the first quarter of 23. And in the second quarter, we're seeing continued escalation, both in terms of signed leases and our pipeline for future quarters.
Up 30%, but is that off of a low base?
It was off a low base, yeah, because we went through, as interest rates went up in 2022 and 2023, as I mentioned, corporate earnings growth slowed way down. And when that happens, companies aren't growing. They're thinking about ways to cut costs. And we saw that. A lot of sublease space got put in the market. There wasn't a lot of new requirements in the market. But now that the environment around corporate earnings is improving, it's improving our leasing because companies are growing again.
So strong corporate earnings make it a little easier to hire more people, as you say.
Yes.
You have to actually get the people into the office.
Yes, that's true too. That's true too.
How's that going? How's return to office going?
Yeah, I do think there's no question that work from home has an impact on office demand. I do think in the premium sector where we operate, it's a little bit less so because the clients that we have generally want their employees to be in the office many days per week. But in terms of what we actually see, BXP manages today about 54 million square feet, and we have badge data on about 50% of that space. And so what we're seeing today versus the last quarter before the pandemic is in New York, Tuesday to Thursday, on buildings that are comparably leased, the visitation is the same. So in other words, the badge swipes haven't diminished at all. So Tuesday to Thursday, New York is back. And Monday is coming up slowly, and Friday's very slow. I mean, by the way, Friday was slowing down before the pandemic, but it's definitely slower today. So that number in Boston is about 80%, also rising. So Boston is also improving Tuesday to Thursday. And then San Francisco lags. It's at 52%, but again, that is slowly improving. And the other thing that we see in the data is that if you look at the unique weekly visits of a worker, that gap between the East and the West Coast is less. However, those individuals are coming into the office fewer days per week on the West Coast than they are in New York or Boston.
When it comes to the stock market, it's been driven so much this year by that so-called Magnificent Seven,
yes,
which seems to be a lot of it related to artificial intelligence.
Yes.
Is that spilling over into the commercial real estate market?
It is. It is. So if you look overall in space demand today, I actually would say the technology companies is the biggest gap. We see most of the demand today coming from financial services companies, law firms, professional service firms, and the technology companies are not leasing space at nearly the level that they were before during the pandemic, primarily driven by the large tech companies. However, in San Francisco, to your point, David, there are a number of AI companies, small startups and medium-sized companies that are taking space. I think the net absorption from those companies over the last year or 18 months has been about 2 to 3 million square feet. And also, interestingly, those workers are in the office, I think in many cases up to 5 days a week.
So when you get a new project, the 341 Madison or otherwise, is the financing there for it?
Yes. So Great question. So on the financing, I think you have to divide it between the private market and mortgage financing that's secured by the properties, and also the public unsecured market. So on the private side and mortgages, it's challenging. There are many banks, insurance companies, other lenders that are not getting repayments of their office loans, and therefore they don't have fresh capital to lend on new office projects. It's very hard to get. We did a very large secured mortgage financing last year on a ironclad building in East Cambridge, and we didn't get a quote from a U.S. lender. We ended up closing the deal with European and Asian lenders. So that's on the private secured side. But if you look at the unsecured market, there are a handful, there are many REITs that are investment grade or not investment grade rated, and they're funding themselves in the public investment grade bond market, which is what we do. And so we have access to that market. In fact, our spreads are at long-term averages. So we're not being per se penalized for being an office company in that market. The overall cost of the financing is a lot higher than it used to be, just because the 10-year Treasury rate is much higher than it was 2 or 3 years ago.
Go back to your Cambridge building for a second. No domestic bidders for it.
None.
So it came from overseas.
Yes.
Is that a larger trend? I mean, because the United States in general is an investment haven right now. You're seeing a lot of foreign direct investment coming in. Does that apply to commercial real estate?
I think so. I think that there are buildings that are selling, office buildings, today. I think primarily they are distressed types of deals, and the buyers tend to be family offices and distressed asset funds. And my guess is the underlying capital for those is a mix of both domestic and non-U.S. sources. But broadening that out, there also are large international sophisticated investors that want to continue to invest in U.S. real estate. We announced last year a major joint venture with Norges of the Norwegian Central Bank, and they invested $750 million in 2 life science developments that we are completing in East Cambridge, and that was obviously a very significant commitment.
Since we started really talking a lot about commercial real estate, there's a lot of emphasis on the premium buildings. You're in premium, but
Right.
there's an A and a B and a C and things like that. Is that difference maintaining? Is it exacerbating? Is it diminishing, the distinction?
Yeah, it's certainly maintaining and maybe even escalating further. So the way we describe it is there's premier workplaces and there's everything else. And the premier workplaces we're defining as basically the top 10% of buildings in our market. Those buildings tend to be a little bit larger, so it's about 15 to 20% of the space. What is the definition of a premier workplace? Well, it's a building where if you have an industry-leading client, they would be interested in leasing space in the building if it was available. So it's that top 10%. And if you look at the data for those buildings, first of all, the asking rent for that 10% is 54% higher today than the other 90%. And the vacancy, the direct vacancy rate, is about 7.5 percentage points. It's about low 11%, which is 7 percentage points lower than the rest of the market, which is at like 17 or 18. And then lastly, the net absorption. If you look at it for the 5 central business districts where we operate, the net absorption of space into that top 10% has been a positive 8+ million square feet. And for everything else, it's been negative over 30 million square feet. So you've got, last couple of years you had companies shrinking, but you also had migration from the B and C buildings into the premier workplaces. Why is that going on? Well, I think a couple reasons. One, all CEOs, in my opinion, want their employees to be working in person more. And one of the ways that they're trying to make that happen is through carrots, not sticks. And one of those carrots is to be in a great building. And a great building is one that has access to transit, has great views, light and air, has great amenities, meeting space, all those types of things. So we see, and we've had clients that have elevated their rental costs because they want to be in a better building. That's a key driver. And then I think the other thing that's going on is the workforce is becoming a little bit bifurcated. So the workers that are product-facing, client-facing, that need to collaborate, they're all working in person. But a lot of support areas like IT, accounting, HR. A lot of companies, by the way, including BXP, has more liberal remote work policies for that workforce. So they're coming into the office less. And if you look at the overall office market, those workers tend to be more in the B and C buildings as opposed to the premier workplaces. So I think those two trends are what's driving this divergence between premier workplaces and the rest of the market.